Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Willow's control. Past performance is not a reliable indication of future performance.
All right, moving on.
And with that, we will jump in.
Right off the bat. We have a lot to talk about.
Yes, lots to discuss today. I think we're going to take a little bit of a different approach. Normally we go through all of our risk slides and everything. We're going to save those for another time so we can talk about some of the more pressing matters that have been really present to us. So.
Okay, so yield curve, you can, what this shows here, oh good, all right. So this line right here, below this line shows that we're heading into recession. So you can see in 2020, when we had the Corona crisis, you can see we started to slip and came back. This was the financial crisis, this was the tech boom, and so on. It's a very accurate predictor. Now, by the time it hits here, our work is already shown back in December that we were heading in this direction. So as you know, we got very conservative in the last quarter of last year. We continue to be conservative. Again, we're going to say this is a time for patience. The Fed has indicated they are not going to be slowing down their increases in yields, and therefore you can expect the punch bowl, meaning the market, the punch bowl, to be taken away. And that's what we saw in yesterday's activity. You saw the market was down, I think, 1,400 intraday, but closed down 1,200. You can see the market is saying, this is where we are. We're headed in this direction. Now, when you see these dips, it's a prelude to the actual recession. You can see the recession took place right here in the gray lines. Once the recession starts to take hold, that's when you start to actually see, not at the very beginning of a recession, but through it, that's where, depending upon how severe it is, that's where you start to see more of a churn in the market, and actually where the market stops its free fall. We're not there yet.
Right.
Something to add?
Yeah, just why this is so important. These yield curves show, what the different tranches of government bonds are paying. So whether it's a 1-year bond, a 2-year bond, a 10-year bond, a 20-year bond, what is the interest rate associated with buying that debt instrument? When this curve inverts, which means that the short end, right, the interest rates on the, say, 1 to 5 year go higher than the interest rates on the longer, and it can signal trouble in the economy. And that's essentially what is happening to this chart on the left, where right now the 1-year rate is higher than the 10, 20, and 30-year rates. And you can see these gray lines. This is more of what this is what it was in the past, a year ago and 2 years ago. And these are more indicative of a healthy economy, healthy markets, healthy expectations for what's coming in the future. And so this really shows that there's a lot of uncertainty out there. There's much more concern for what's going on in markets and the economy in general.
An inverted yield curve, there's like inverted yield curves, steep yield curves. Inverted yield curves always a prelude to recession.
And we were talking about recession back in Q4 last year, saying that inflation was not transitory, that many of our indicators are popping off to say, watch out.
Yeah, August, September last year, if you remember, we said inflation isn't transitory. We're going to talk at length about that going forward, but just let's keep going.
So again, just make sure everybody can see, this just shows that all the interest rates here for these different bonds, and each line is, the 1 year, the 2 year, the 3 year, and what their interest rates have done over time. Everything is going up.
Yeah.
And really tightening there too. Normally, you'd want to see a spread between the short end and the long end, but when it all comes together, it's just one more sign of
Something's not
concern.
healthy.
Right. It's not a sign of a healthy economy or market.
Yeah, wealth distribution, this is, you know that this is something we've been talking about for a very long time. We're not just talking about it at the individual level, but also at the corporate level. You see consolidation in corporations. You see what we would call more oligopolistic, not quite monopoly, but you can call it, some people will call the actual gas industry close to a monopoly. What and why is this concerning? So this particular one is wealth distribution overall, and you can see the top 100, the top 1% are definitely getting the share of the household. The bottom, look at this. Oh, Paul, can you bring that back? You can use it. The bottom, the green line, look at this. This is instability. The next one up, this next one up, the purple line
here.
That's the next 40%.
The bottom 40% of people, right?
And then the next one, 2 to 9%. So this wealth gap, again, last year we said civil unrest. This is at the core of civil unrest anywhere in the world. And this is happening not just here, it's happening across the globe. And so, as we said last year, our biggest wild card, our biggest concern is civil unrest and where that's going to lead to. Now, the policies that have been put in place, not just in the last few years, over the last several decades, it was predictable that this would happen. It was predictable. We predicted this 10 years ago when we started the company. This gap is widening, and this is very unstable. And now with inflation, you can see it's just gonna, if we actually updated this chart to today, because it's not updated to today, to 21, or is it does it include this year? It's hard to tell. Yeah, it does run into 22. Look at that exponential growth.
This is from COVID onset is right in this area. And you can see that since COVID, all of these policies and things that they had in place really benefited that top tranche so much more than the remaining 99%. What this chart doesn't show, though, and it would be interesting to see, is that 0.01%.
Which is even more.
Which is even more.
Which we have to put in the next one, because it's really not the 1%. Because now, okay, so you saw, we know that let's say the low income, they've been hit. Low middle income has been hit. Now with inflation, the middle income and the higher middle income has been hit. Now they're going after the high net worth individual. And I'm saying going after. Okay, yes, I'm using those terms because the policies are creating this. And if we can sit here and we can know that the policies are creating this, then they know that the policies are creating this, okay? Because supposedly we're not the smartest minds.
Yeah, how is that? Anyways.
So that's the problem. So if we actually break this down by the 0.1%, it would be actually worse. So let's go forward.
Yeah, so just in that same vein, because as we've mentioned, right, one of our biggest wild cards here is social unrest, because when people reach a certain point, whether that is they can no longer pay for food or bread, right, or the cost of heat goes through the roof and you can no longer make your bills, it leads to lots of discontent. And from that instability, volatility, uncertainty, all things that can hugely affect markets and our everyday life. So that's why this is something we believe is very worthwhile to keep track of and understand. And this, feeds into that, right? There was just one of the largest nurses strikes ever is happening. This was dated today or yesterday.
Yeah. This is and for some of those who may know, at one point I talked about the fact that our healthcare system was on really in distress and only getting worse. And this isn't just about the nurses walking out of their position. This has to do, again, with a lot of policies that have been put in place.
Misaligned incentives really is what drives healthcare industry to really not focus on
Healthcare,
healthcare,
and healthcare, yeah,
helping,
and helping.
right?
And of course, this
Through
rail
bad
strike,
policy.
yeah, bad policy. Rail strike is this is not the time for a rail strike, okay? Sometimes we talk about the fact that there must be a bunch of apples somewhere in the United States, and there must be a bunch of bad apples in there somewhere that are making the whole bunch go bad. Sorry, this is how we feel, because this isn't the time for a rail strike. And you just have to wonder what's happening here. We are already experiencing supply disruption. We are already experiencing the rise in prices due to this supply disruption. If this happens, supply disruption will be even greater than what we're experiencing today. So what is going on here?
Right,
This-
and the cost of transporting goods is already at or near highs. Yes, they've come down recently, but it's still up tremendously from a year or so ago. When you destabilize something like rail, which moves a huge portion of goods around our country,
As we look at
as there's a train,
as the train is going by right
right.
now.
it adds even more cost pressure. All sorts of issues arise from that.
Yeah. Now here's, well, actually, we can go forward to, I think. So here's the inflation data. And this is, again, we're going to say it. It isn't transitory. Unfortunately, the Fed is not going to have a lot of control on inflation. Why? We have a ton of externalities. One, we have some global disruption, as you know. We have policies at the government level that are not helping. So this inflation bill, well, it didn't work. Okay, we're 1 month into it, and they're celebrating.
You can't legislate inflation away.
No, and it's in the necessities. You have to understand it's in healthcare, it's in food, it's in energy, and there's only so much of that you can claw back. So let's talk about what's happening
How
in
much
Europe.
heat can you do without?
I can't do it.
How much?
So here's a concern that Paul and I've been talking about. Hopefully you are all following what's happening in Europe. I happen to be married to a European, okay? And things in Europe are deteriorating exponentially. So let me give you real examples. Heating costs are going up. So there's a hospital, 1.5 million in heating costs. They're up to 4 or 5 million? 4 million, for close to 5 million in Belgium. Now, the hospital's thinking of closing down. Now, why is this? Everybody's going to blame Putin, but it has nothing to do with Putin. It has to do with price gouging, because the company based out of France, their division, their subsidiary in Belgium, made $8 billion more this year in the first 6 months than it did last year. 8 billion. 8
And
billion.
if that company's
And-
cost of energy is that much more, how did they make that much profit?
Yeah, so it's a 200% increase in revenue from last year this time to this year this time.
Right.
So their cost of inputs are not going higher, or maybe they are, but they are. I know they're going higher. They're going higher, but they're more than passing that on to the consumer. The largest meat packing company in Belgium is on the brink of going bankrupt. Local mom and pop shops are closing. We cannot think for 1 second that will not happen here. That's the problem I have. We can't think for one moment that this will not happen here. There's a number of reasons for it. Again, policy, they closed down the pipeline without having a plan. They want to move to electric cars without having infrastructure and actually increasing the amount of coal that we use.
You want to close the pipeline down and move to more energy independence? Awesome. Yes,
We're
this is
all
a
for
great
it.
idea. Everybody
Love
should be doing these kind of things. But you need a very thoughtful plan in place, and then you actually need to do it.
Right. Plan it out. And this is what's going to continue to disenfranchise lower income brackets, middle class, now upper middle class.
They
And
get hit the
soon,
hardest from, a small increase in energy costs disproportionately affects those of lower income than those with higher income,
Yeah.
right? You're already spending more of their budget on the necessities, and now even more of that already constrained and limited budget has to go to these necessities.
And I think we all live in the real world. I could be wrong.
Who knows
I
in
think we
today's
do.
world?
But adding 87,000 IRS agents that's added in the inflation protection or the inflation lowering bill, I'm trying to figure out how that actually lowers inflation. It just raises our costs. So really, there's not a true focus. Where we have to focus is the areas of necessity, securing our food, securing our energy, securing our healthcare, taking care of our people, taking care of each other. Community, taking care of each other. I'm sorry to go off. So what does this all mean in the end? Let's go forward. So why, I don't want to be on a soapbox, but it's just, it's
good. We need to talk about this.
It's disheartening to watch these things happen. And so why is this concerning us? Because we think the markets are at risk.
Mhm.
And if we didn't know better, we'd say it's almost a plan to obliterate our system, honestly. And
yeah, looking at the data, that's just sort of the story that it's really telling and pointing to. I mean, there's so many ways to avoid so much of this conflict and pain that's out there in the world, and yet policymakers, politicians
Globally.
around the world for
Globally.
the past several decades have not chosen to go down.
yeah, let's talk about the net effect on the markets, okay? So what you see is over the last few months in here, we hit this bottom and the market bounced. We fully expected a bounce. And we have to remember, the market is a breathing, living organism because it's made up of humans are the ones who trade on this thing. So you have to think about it as in breath, out breath, in breath, out breath. So here we said, oh, let's take a nice in breath. Let's rally back right here. Paul put right in the 200-day moving average, almost like clockwork.
Blue line.
This blue line right there is the 200-day moving average. When
Touched it, it's super clean, technical resistance rejected.
rejected, right? And yeah, go ahead.
Well, technically on longer time frames, when you see resistance hit at on these moving averages, it's a sign that the trend is not over.
Yeah, the trend to the downside. In other words, the trend to the downside isn't over. Now, we were wrong in that we thought the market would bounce before the election. You know, that
I mean,
would
it
be very
did
typical.
from June to
Yeah,
August,
we're not even
but
there yet.
it's sort of really falling
Yeah.
apart
Yeah,
before. So.
yeah. So given what we see happening economically, so inflation eating away at the budgets of the consumer, they're not going to be able to have discretionary income like they did before. That is absolutely going to affect industry. So we don't anticipate a really good quarter going forward in terms of earnings. And the market's telling you that. So when the quarter ends, this quarter, September, the market is saying October won't be so great in terms of earnings season. And we fully expect that. We also expect that energy prices will go higher in the next quarter because nothing fundamentally has changed. In fact, it's gotten worse,
Right. The
not
fundamentals
better.
behind
Yeah.
so many of the energy markets, all the different pieces from exploration to drilling and mining to renewables, refining,
Yeah.
all of the pieces paint a pretty bleak outlook unless, you know, the world can come together and figure it out.
So if we do see prices go higher, it's just going to chew away at the profits even more. So going into earnings season, maybe in October, we'll see some companies have some relief from their inputs from energy here in the United States, but we don't anticipate that's going to last. So what does this mean for the portfolios, right? So we've been conservative and we will continue to stay conservative because until the market shows us, because remember, the market itself is a leading indicator. Remember, the market was deteriorating before we started to see any of the inflation numbers come out. Before it was, we started to see the inflation numbers in our work for sure last year because we were watching the necessities, not the whole basket. So So we anticipate that this is a time, and for those of you who've been with me during the financial crisis and the tech bubble, you know, sometimes you just have to be patient. So what have we been doing? We've been buying treasuries because we can actually get a
Short-term
decent,
treasuries, right.
short, really short, like 30-day, and just roll in, because we want to have powder dry for when this changes, for when the cycle changes. The point being, from our perspective, is the cycle hasn't changed, and we're still in a downtrend. And we do get the question, like, aren't there buys in the downtrend? Yeah, but we're not interested in catching a falling knife. And what we're seeing is that there are things we like, earnings, technically, but then it blows apart like that, which is very typical for a bear market.
Yep.
Very typical.
Yeah, a couple other technical signs too. Yesterday was a huge drawdown. It was like a 5% move in markets, which traditionally you don't see those very often, and you don't see those really at all in a healthy market.
Yeah.
You know, in bear markets, yes, you do see these crazy volatility days where you can have multiple, you know, percentages up several percent, down several percent. It happens. It's pretty normal actually in a bear market.
Yeah. The other thing I want to point to is, if you can see this, it's a little faint, but you can see the red is above this trend line here. Red indicates negative days and this number here is volume. So you can see above the trend line is more red as a whole. Okay. That means
there's more sellers than buyers.
More distribution. So we don't want to be the fool sitting and saying, oh, we're going to be fully invested here. It's just not unless you, our client, said, this is what I want. Would we do that? But what do we want to do with our own personal money? We want to be conservative right now. It just makes logical sense. What do we want to see? Well, we want to see policy changing. What does that mean? We want to see somebody actually admit that, look at this inflation number. If you really peel it apart, it's in the necessities. So how are we going to deal with this as a community?
Yeah.
How are we going to deal with the rise in food prices, the rise in energy prices, this potential rail strike? How are we going to deal with this? We have to divert that rail strike.
There are core structural issues that need to be addressed and thought through, and not just, you know, slap a Band-Aid on thing. A great example of this was a few weeks ago, the EU was talking about putting price caps on energy costs, which have never worked in history. I don't know why they think it would be different this time, but, you know, some common sense actually did come through there, and they've stopped talking about that as of a few days ago. So
no, it's not that we, I mean, price caps. Yes, we
theoretically, it's a great idea, but in actual practice, it just doesn't work and never has.
That's too bad. It should. I don't like that. All right, let's go forward.
Yeah, that was the S&P 500. This is the NASDAQ. You hit these resistance line. It didn't even make it to its 200-day moving average before it was rejected. Continued its path back down. It then hit its 50-day moving average and really made it above before coming down. So it's just across all equity markets right now. And technically, it doesn't look great.
Yeah. So what do we like?
Yeah, we didn't need to go through all of these. We're just putting a list together, sort of like the things on our minds for this coming decade.
And these have been themes. Like some of this has been themes that we have followed. For some of this is 10-year themes, and some of these things are just things we're seeing come up, like the global energy crisis. It's real. It's happening. Global food crisis. It's real. It's happening. Again, when we talk about policy in the inflation bill now, they want to lower the carbon emissions for farmers, which means they want them to retire some of their livestock. Okay. During a time when prices are already higher, this is not the time to be having this conversation like that. If they do it the way they did it in Holland, it's an abrupt stop. And if you know what's happening in Holland, food prices are off the charts, and farmers have been closing their farms. So now they're actually in a much worse food crisis than some of the other countries. Global dollar crisis. This is something we think could be down the pike. Right now, the dollar is hitting a new high, well, kind of hitting parity with the euro, but it did hit a new high against the euro. So the question is, how long will we be a leader? As long as the United States, we're not a leader. If you really look at the dollar, the trajectory's been generally down. But generally, when in a rising interest rate environment, the dollar gains strength. That's what it's done recently. So lack of faith in leaders, no question about it. That's especially at this, but these people, this generation and younger, they really have lack of faith in leaders and institutions.
Right.
It's
sort of failed. Now, the feeling is, anyways, that generally they have failed us in so many ways. From here's this great future, you know, when you're a kid, you're told, you know, the limitless possibility, you got this great future ahead of you, and then you do everything right. You know, you get your college education, you get out there in the workforce, and then it's just like one thing after another. You know, these once in a lifetime, you know, financial crises that have happened. What, this is like the third time now?
well, yeah, see, this is, this is what, you know, people, I think a lot of you are my age or older. So for us, you know, we've had some crisis, but we've already been well entrenched into the workforce and, you know, I think in pretty good shape. But if you look at the whole, this group's, and, you know, they've seen their parents go through the financial crisis. They've seen their parents go through the tech bubble and be affected by these things. So they
say
have a
that
really,
the millennial and onward generations will be the first in, you know, I don't want to say recorded history, but recent history where they will actually have less wealth than the preceding generation.
yeah, so, you know, these are like, so when you see lack of faith in leaders and lack of faith in institutions, if you pay attention to, and this is what our job is, okay, so understand, our job is to understand how those generations are thinking, because those generations are going to support this market that is supporting us, who are, not me, but those of you who are in retirement, but I will be there in, I don't know, 10 years or so. So, you know, you have to know how they're thinking and where they're going and where they're putting their money. And this is really interesting. So I find it, you know, concerning, of course, and also destabilizing as well. So end of cheap money, there's no question the Fed is raising rates. So we know, the question is whether it's a long-term change. That's the question. We don't know that yet, but the charts will tell us. Resource wars, we've talked about this. Water is a big concern. And now this year, really, it catapulted the droughts that we're seeing across not only this country, but the world.
Yeah, not only it's all the resources too, from fertilizers to food, there's huge disruption in those markets. I was reading that the past 20 years or so we've really been able to make all of our increases in food production that correlate perfectly with increases in fertilizer production. And so now these markets are being tested through global conflict, disrupted supply chains. Basically, it leads to a loss in generation of calories. And when you have less calories, it means more people go hungry. And when people go hungry, it causes more civil, social, societal unrest, more destabilization. And as of right now, it does not really look like these things are being addressed in a thoughtful, compelling way. It really does more look like countries sort of circling the wagons and moving to more nationalistic ideologies of I got mine, and you know we need to protect ourselves and forget about everybody else. It does seem like those trends are moving forward. I mean, these things take years to really play out, but then it's sort of all at once.
So I think, you know, we'll skip some of these, but deterioration in the quality, these are not necessarily things we believe. Like, I don't think the tech crisis is coming really at this time.
Technology crisis in the sense of AI, machine learning, these things have gotten so far ahead of our own thinking, and that they can then be used and are being used to affect public opinion. This is all, you know, documented. There's a Cambridge Analytica, all these different things where you can use AI to unleash a specific worldview or narrative on social media or through targeted advertising campaigns to get people to think a certain way. And this is happening. It has been happening. And as technology increases over time, the ability to do this increases exponentially too.
This is true.
And I mean, let's be honest, we are, you know, monkeys, right? With our monkey brains, competing against compute power that is millions of times exponentially more equipped at processing data and coming to conclusions than we're able to. So this huge mismatch, and without very, very thoughtful regulation or just ways to address it, it can become a very, well, quite frankly, terrifying thing in the short term, because if you have one person or one group of people who all of a sudden decide, hey, we want to get the world leaning this direction or that direction, or to think a certain way, or to use deep fakes and all these ways to, make fake information or whatever, you can do it from your basement with economies of scale and all these things. And who's talking about this? What regulators are out there putting forth regulation to address these kinds of things? They're going to cause problems down the road.
I mean, to a certain degree, they may already be doing
They
so.
probably already are.
So European canary, I don't want to go into too much farther, but the European, one of the things we are concerned about is the potential breakup of Europe over all of this infighting now around energy and resources. It's not looking too positive there.
Right, or it's a forced coming together, right?
Or a force coming together. It's
United States of Europe.
one or the
because
other.
Here's an enemy, and
Yeah. Who knows how this is all going to play out, but it's pretty bad.
And it does seem like a lot of the energy issues and things are going to play out there maybe first before they spill over to the US or the rest of the world.
So things that we believe in, caring capitalism, we put that in place here. This group, we care about you, we care about each other, truly, truly. It's a lived value here. And we really think that that's what's going to help our world, help our economy, is if we can move toward more of heart-centered management. Community resilience, we think this could ultimately lead to that.
A lot of it comes down to people and what we collectively choose to do going forward, given the multitude of issues out there. I mean, one thing to always bank on is people's resiliency, ingenuity, and hearts.
Yeah,
right?
Let's hope for that. That's still the technology that lives inside of us. So technology crisis, maybe we can just do something to amp ourselves up. But we won't go too far into this, but these are just some of always the conversations that goes on between Paul and I. Sometimes we have differing opinions, on a lot of this stuff. But okay, so this is generally what we talk about and think about here all the time. Now let's just talk about, I think we're done here, right?
Yep.
I want to just start. So let's just talk about positioning and where we are. Okay. What are we looking for? We are looking for a couple things. We do want to see that the Fed is going to start backing away a little bit from what they're doing in terms of raising interest rates, or some conversation around, wait a second, this is a problem of necessity, not of it's a structural issue. It's a deeper problem. We'd love to see those types of conversations. In lieu of that, what are we looking for as investors? We want to see stabilization in the market. We want to step aside right now and let it come to us. Okay, we're not chasing. There's always going to be an opportunity.
Everything always moves in cycles, and this time will be no different.
Yeah. When the tech bubble came, it was 3 years. It peaked on March 10th, 2000. And it bottomed in somewhere around September of 2003, 3 years. Okay. In the financial crisis, it was a much faster turnaround. It was almost a V-shaped recovery, which was unbelievable because the amount of flooding of money into the system. That's what we need to see. We need to see the velocity of money.
Point, one of the big issues is that the Fed is in a really interesting position, because if they all of a sudden decide to start flooding the money again, or flooding the economy again with money, when inflation is already an issue, it can potentially compound that.
Yeah, but again, it's the necessities, right? So I mean, hopefully there will be a little bit of a slowdown in the cost of rent prices have been going higher really fast. So hopefully we'll see something. But anyway, what we want to see is at least the trajectory of their rate hikes slowing down. The rhetoric out of the Fed. And we also want to step aside and see what happens with this market going forward. I think the next 3 to 4 months are very, very important to us. Meanwhile, how are we positioning? We cannot predict where this is going to go. Can't. We have to let the charts, we have to let the breathing, like we said, the in-breath, out-breath, we have to let it tell us where to go. And it will tell us, again, the market is a discount mechanism. It looks 6 months forward. 6 months forward. This is, so it's always 36 years. It's never failed me. It's never failed me ever to say 6 months forward where it's going. So that's what we know. That's what we know and we understand. So right now, what we're saying is patience. We know we want growth to come back. We really want growth to come back. But right now it's about patience. The types of things that you have in your portfolio are the things that people need, that for the most part, and you will see that we're a little bit more active. If we have a gain, we're taking it. And we bought something not too long ago. I think we had what, a 13, 14, 15, no, 20% gain, Cardinal, and like 2 or 3 weeks. So we're like, that's a whole year gain. And it's the same thing on the loss side. Like we have to protect now on that side of the equation as well. So it's not a fun time, but it's a time for, like, in our mind, a lot of vigilance. So
paying attention, being more active, these are all necessary right now, with just to sum up, the general theme of being more conservative given current conditions is absolutely warranted.
Yeah. And so somebody asked a question, I think this is really interesting. How are you thinking about civil unrest and portfolio positioning? So conservative. I mean, that in a period like that, we have to be conservative. We are favoring actually treasuries. If the treasury goes down, then we're indeed, then it's a much bigger problem globally. We're not saying that can't happen, to be honest with you. It just depends upon how bad. So, I mean, right now, for us in a civil in an environment where there's civil unrest, if it only gets worse from here, because the homelessness issue is becoming really bad, and if it only gets worse from here, then we have to question a lot of our positions, and we would have to get very good.
Just as a rising tide lifts all boats, a lowering tide lowers all boats.
Yeah.
And that's very true in markets.
Yeah, we just don't know how the government will respond to such a thing. And I think depending upon the type of response that we have there is like, just like in the financial crisis, the response was swift, it was smart, it was, they just knew what they needed to do to save the situation, save the day, really. And so the turnaround was quick. So it really depends upon what the leadership here chooses to do. If you have an opinion, I suggest that you start voicing that opinion to your senators and your
one of the best things.
congresspeople.
The only things we can do, right, is to be more active.
As best as we can.
Right? Reach out to those people who have the ability to make the changes we want to see and try to push that forward. Yeah.
And the other, somebody asked about what type of treasuries, and we're staying really short. So we'll go 1 month or 3 months, 6 months. So we're rolling. We're rolling. I mean, 1 year, what costs like a 1 year at 4%. Now, when I started my career, it was a 1 day at 4% because we were looking at like 25%.
1 year, actually, since I've been in this industry since 2009, I have never seen a 1 year at 4%.
Yeah. Yeah. Somebody asked a question about fertilizer. Well, okay, so somebody's asking about fertilizer as a chemical. Yeah, so much for a lot of fertilizers.
NPK,
yeah, it is.
Potassium,
Yeah.
nitrogen.
Yeah.
Right. So one of the major problems with global food production is in fertilizers, right? In order to grow things at scale currently, I mean, there's all sorts of arguments around, the health of it and whether it's actually quality food or not. But to actually grow at the scale that we currently do, it requires these chemical inputs to meet that level of production. Theoretically, you could move to a world that was supported by small scale sustainable agriculture, but it would require a massive, massive shift more people growing victory gardens, basically everybody doing this. So it is possible. It's possible to feed everybody in the world through those kinds of means, but at scale, it's a much, much harder challenge, at least in the short to intermediate term.
Definitely. This question about crypto markets, somebody wants to know what you think there.
Yeah, so the next 12 to 18 months, it's going to follow very closely equity markets, as crypto in general is seen as a more risk-on asset. And as markets, go down and generally a risk-off situation, the trend will most likely follow that. What is very encouraging to me is that actually, I believe it's tonight or tomorrow, early in the morning, Ethereum moves from proof of work to proof of stake. I won't get into the details, but it results in a 99.95% reduction in the energy that it uses. So it therefore makes this entire digital platform one of the greenest digital economies in the world, which is pretty fascinating. It improves the economics of it. We're also seeing some really interesting developments happen in this space.
Mhm.
Starbucks just partnered with a company
Polygon.
called Polygon, which settles to the Ethereum network to do all of their rewards. This was one of the major use cases we talked about with NFTs, was that you could have companies move their reward systems, like credit card rewards or user loyalty reward points, whatever they are, onto these systems because they're way more efficient, way easier to get in contact and give incentives for potential customers to use your stuff. And so that's really moving forward. I expect a lot of building, a lot of those types of relationships to develop over the coming 12 to 18 months or so. So we're going to see this really big, I think, now that this transition has happened from proof of work to proof of stake, arguably a much more sustainable model, that there will be a lot more, I'll call it institutional adoption, where more big players start saying, hey, you spent the last few years toying with this place, doing pilots. Now you're going to start to see some of the fruits of that, just like this Starbucks Polygon partnership.
Yeah. Yeah.
So
that's his take on the next 12 to 18 months. But do know that the macroeconomic environment always trumps everything. This is something this is new for Paul. This is his first time he's been in a downturn since he's been in this industry. So it's kind of cool. It's a good teaching opportunity for me. and he's seeing this and that's the hard thing that you have to know is we don't have attachment to any of our investments. Can't, because it doesn't matter how good they are fundamentally. When you are in a downturn, you are in a downturn. You can have the best company fundamentally, and it will follow the trend. So, that's really important. Looks like we have no more questions. It would be really helpful if you would be kind enough to email us and let us know how these are hitting you. If there's anything more you want to see, you want to hear.
We love your feedback. Any direction
please.
that you'd like to see, points you'd like us to go deeper on, or areas of markets, economy, whatever that you're interested in learning more about, let us know.
Yeah, from our perspective, this is like something we breathe, eat, drink, and understand. So we don't want to get over your head, but we also want to just let you know our thoughts, our feelings, and what we're experiencing. So again, let's see. Let me see. I want to just see. What's that, Paul? Do we have any? Does anybody want to ask any questions? You can raise your hand and ask a question. Okay, go to your meeting. He has to leave, and he needs his computer. So we're finished.
Yeah. All right.
So we'll talk to you.
Shoot us an email, like we said. Give us a call if you have any follow-up questions.
And do let us know how this hits you and what you need from us. Okay, because we don't want to scare you. We just want you to know that we understand what's happening. We believe we understand what's happening, and we're right there with you, trying to make
complex, dynamic world out there.
We're trying to do our best for you. That's what we're doing.
All right.
See you.
Take care.
Bye.
Thank you.